fourth quarter saw a relatively slow start, but clearly post-election saw a very dramatic rally. From the Friday before the election until where we are today, the market has risen about 10%. The major averages are all up about 9 to 11% in a relatively straight line. Clearly much more bullishness about the pro-growth agenda of the administration. I mean, there's a lot of talk about lower taxes, less regulation, the potential to re-domicile a lot of overseas cash, all really focusing on growing the economy and bringing jobs back to the U.S., all of which are very positive. There's been a very significant rally in certain sectors. Anything commodity related has risen. Financials have done incredibly well on the hopes for less regulation, particularly deregulation. And you've also seen a broad rally in a lot of technology companies, many of which can benefit from bringing cash back, repatriating cash that is held overseas, of which the dollar amounts are hundreds of billions of dollars just in the technology space alone. Along with that, interest rates have risen, the dollar has risen, and levels of bullishness have risen. It's been a pretty broad-based rally since early November. The best performing sectors within the portfolio and the market have been some of the more cyclically oriented areas. There's been a big rally in commodities, clearly more bullish sentiment around infrastructure and infrastructure spend, which has helped both construction-oriented companies as well as certain commodity-related names, including energy. So cyclicals have done well. There's been a big rally in technology as well, particularly since the spring. We've seen a sizable rally really across the tech spectrum. Both hardware and software-related names have done quite well. A lot of the storage-related companies, particularly some of the names that we own in the drive and flash memory-related space, are up actually double from where they were back in the spring. So with less regulation being the norm today, or at least the expectations today, there's been a big rally in financials as well, which has certainly buoyed the averages. Whereas the health insurers have done very well, the therapeutics companies, biotech, some of the specialty pharma names, both in the market and the portfolio, have significantly lagged the market. We've always been long-term business owners. I mean, we've owned some of the companies we own today for 20 and 30 years. And I think it's much more difficult to predict political events or even macro events like Brexit than it is to buy great companies with great balance sheets at cheap valuation levels. And we've always said that good businesses are going to be monetized over time, whether in the stock market or by third-party companies. And I think what we'd rather do is position the portfolio for an environment like today where we think growth is going to remain somewhat challenged, where interest rates are pretty low, and find companies that are undervalued within that context. And I think the biggest thing for us is if you can buy companies trading at less than 15 times earnings that can grow at double digits, over time that you're going to get paid for that. And that's how we try to position the portfolio.